Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
But just in the skew, you can actually see how much the skew is changing. Right, so the downside skew didn't seem as bad, and the volatility was relatively low. And as the stock is melting down, you can see how drastic the volatility is moving. Let me just show you a couple of other ones, maybe Microsoft. Now, the trend that I've been seeing recently that's kind of weird is the back month is higher volatility than the front month. If you look at this, you can see how these months are 28, 29, and it's actually going up. Let me look at Walmart. You see how January volatility is going up, and you see the skew, and the blue line is actually higher than these other lines. Normally, they should be the other way around. So the front month should be high, and as it goes back, the skew should actually flatten out. But a lot of these stocks, the volatility in January is high, which is indicating that the market is in for more volatile time period to the end of the year. So you can kind of see, like, normally the volatility should be skewed downwards, but recently all these big cap stocks, even the volatility is saying that things are going to happen. Let me show VIX real quick. Now the VIX, people always talk about the VIX. The VIX skew, you can see how the front month is higher than the back month. But this VIX skew is an upside down frown. And you can see how the volatility actually goes lower as it goes further out from the at the money. And the reason why it's lower is the chances that the volatility, the VIX will go really low, or that the VIX will stay at a really high number for an extended period of time is pretty low. So most of the volatility is right here in the middle, and as it goes further out, it's getting cheaper. All right. So I think that's pretty much it for now. I can try to open this up. If you guys have any questions. Oh, okay. I didn't see this. SGD, HKD, and CYB, and SPY. Okay? All right. So the first one is SGD. Does this have options, do you know? All right, let me try the next one. HKD. Oh, these are Hong Kong indexes. I don't think we have them. CBY. All right. Okay, so for these, let me actually do all premiums. So you can see how, since this stock does not have that many strikes and pretty much has no premium, you can see how this one strike is dime bid at 20 and then the very next strike has no premium. Basically, if it has no premium at all, there will be no skew because the skew measures the premium of the strikes. Let's do SPY. And you can see in SPY how the skew is tilted towards the puts. And let me see if I can play back for a month. You can see up here. So this has a lot of strikes, so it takes a little time to load. So you can kind of see how the skew is changing over the course of the month. So you can see like this angle of these different puts. They were a lot closer and flatter at the beginning than they are now. So you can kind of see how as the market is like selling off, these lines keep getting higher. You can also see the volatility going higher as time goes. So you see how like the vol was down here when we started, around 12 vol, but as it exploded, you can see that at the moneys are around 28 volatility. Okay, why does it have a hook? And okay, what strategies? Oh, you mean this hook right here? Right, so this is the call. So as it gets out of the money, see these things have premium, they'll actually have higher volatility going up. So the thing that you have to be careful of is you see these May 120 calls, it's 1 cent bid at 2. It doesn't really matter what volatility that is. Basically, any options under 50 cents, you know it's 50 cents. So if you sell that option, the most you're going to be making is 50 cents no matter what, even if it says it's 500 volatility. So any options that are 50 cents or less, I would just look at the absolute premium value of that option versus looking at the volatility. So this hook is saying because it has some premium, and since the chances of it going to that is very low, it just has if you use the formula, it just has a very inflated volatility, but it's at expiration, and this doesn't really mean anything. Some of the strategies that you can use using the skew is, I think, a lot of times you can use same strategies that you would use otherwise in terms of like technical trading. So a lot of times I use technical analysis. I do like earnings. I also do different order flow to make my decisions. But let's just say like right around here, you were thinking like, hey, the market was going to sell off. So let's say at this point, you're like, hey, it's going to hit this point and it's going to sell off. What kind of trading should I do? If you know that the skew is high and the volatility is high, the last thing you want to do is just buy a put, right? So basically, you want to buy a put and maybe sell one of these higher strikes. So like these, I would kind of not even pay attention to because these are expiration options. So the last week of expiration, these volatility numbers don't really mean as much as these right here.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.